Good morning or good afternoon, and welcome to our webinar, Demystifying Derivatives, a Strategic Alternative to Enhance Profitability. My name is Jeff Rigsby, and I'm the President and CEO of CB Resource, and I'll be hosting today's session. First, I do want to take this opportunity to thank all of you for taking time out of your busy schedule to join us today. In our invitation, we said the presentation will run about 45 minutes, and we have allowed for a little bit of Q&A time with our guest speaker and panelists as well, but we're definitely committed to stay on schedule and respect your time. You know, just a quick word from Vining Sparks, Interest Rate Products Inc., CB Resource, and Finance 500, who are jointly hosting and sponsoring this event today. We certainly recognize that these are unprecedented and uncertain times. With the significant margin compression that we're experiencing within the industry and the likely weakening of credit portfolios, there may never have been a more pressure on earnings. So we hope over the coming months we can provide useful insights like today's session to continue with an eye on profitability and provide hopefully useful information that all of you will find of value. So let's go ahead, and before we get started, just to let you know, to get the most out of the webinar, there is an instant messaging capability here. We will be monitoring your questions. Oh, by the way, I do want to make one comment about your screen size. If you find it's not filling your full screen, you might want to maximize it up in the right-hand corner. Sometimes I've had feedback where that occurs. So by all means, if you're not seeing the full screen, you can usually click up in the right-hand corner and that'll fill your screen. Anyway, back to getting the most out of the webinar. There is an instant messaging capability, and certainly we welcome all of your questions, and they'll be channeled through me, and we will carve out that time at the end of the session to bring your questions forward, as well as invite the panelists to join us. So let's go ahead and get started. Oh, by the way, the presentation is available upon request, and there will also be a recorded version. So let's get started. Before I introduce Rick, I want to introduce our two panelists that will be joining Rick during the Q&A. We have Jamin Ragsdale, who's the Senior Vice President and Principal of Finance 500. Finance 500 is a registered broker-dealer serving community banks' fixed income needs across the country. We also have Robert Finch, Senior Vice President and Director of Sales and Marketing here with CB Resource. And Robert is also our profitability subject matter expert within our organization. So with that, I'd like to introduce our webinar speaker, Rick Redman. Rick Redman is the Director of Balance Sheet Strategies, check that. Rick Redman is joined Vining Sparks in November 2008, currently serves as Director of Balance Sheet Strategies for Vining Sparks, IBG, and President for Vining Sparks Interest Rate Products, LLC. His primary responsibility includes working directly with financial institutions to develop and execute risk management and earnings enhancement strategies. Rick has over 35 years of financial services experience, with the last 16 years spent working directly with community financial institution clients. Rick spent the first 20 years of his career working with two large regional banks, where his roles included Treasurer, Director of Treasury Risk Management, and Assistant Controller Financial Analyst and Planning. And with that, I'd like to take this opportunity to turn this over to Rick. So I'm going to power over the presentation link. Oops, sorry about that, Rick. I'm going to make you the presenter. There we go.
Perfect. You guys bear with me while I bring my screen up here so everybody can see it. And I think that's got us where we need to be. So anyway, thank you, Jeff, for that kind introduction. You know, the older you get, the longer your bio gets. And so mine has gotten very, very long over the years. So I apologize for Jeff having to read all that to you. Basically, I work with community financial institutions to help them manage their balance sheet. It's that simple. And so what I wanted to talk to you today about, though, was interest rate products like swaps, caps, floors, those kinds of things. And, you know, we're going to cover a lot of ground in this session, but what we've tried to do is break it down into kind of swap basics and then some ideas about how you can actually use these products right now. And, you know, there are some very, very good ways that you can use them right now to actually enhance profitability. more so than probably any other time that we've been involved in derivatives. But we're going to start with, very, very basic information. Why use swaps? What's the market for this? We're going to talk a little bit about caps and floors. We're not going to spend a lot of time on that. And then we're going to talk about how you would implement a program like this, and then give you some ideas. And then we're going to wrap it up with a panel discussion, and hopefully you'll get a lot out of all of this that we're going to talk about today. So let's go to the first slide, and that's always the big question is why? Why would I use these products? And so I think, it's really a business decision. There's got to be a business reason for using any of these products. And so the bottom line is you can use these products to help you create capacity to meet customer demand for products where those products create excess interest rate risk. A lot of times we'll see banks that try to manage their interest rate risk with their customer base, and we find that that's not the most efficient way to do it, nor is it the most profitable way to do it. So, creating the capacity to meet your customers' demand for products is a great way to get more business and to get more profitability out of that business. It typically also provides lower overall funding costs versus your wholesale alternatives. And we're going to talk a little bit about some of those opportunities going forward. And I apologize for all the noise and stuff you see coming around. I'm actually working from home, which I know a lot of people are right now. And so I've got all kind of communications coming in here. And so I apologize for that. It also allows for efficient adjustment to your interest rate risk profile without impacting the customer base. That's what most people think of when they think of swaps and caps and floors is, hey, these are great tools to manage interest rate risk. And they are. They're probably the best tools for managing interest rate risk. But there's also these other capabilities that they create. So keep in mind those things when we talk about how versatile these tools are. And then they obviously are very efficient in terms of using capital, because you're not putting the entire notional amount of a transaction on your books. You're only really affected by the market value associated with the transaction. So if I put a $10 million swap on the books, it's not going to use up $10 million worth of capital. So let's go to the next slide here. I can. This is a question I get an awful lot is, okay, if I enter into a swap, there's somebody on the other side betting against me, right? And the answer to that is no. That's not the case at all. The swap market was developed to bring together people who had different needs, to bring together those who needed to pay fixed with those people who needed to receive fixed on swaps. And in fact, the very first swap done was in 1981 between IBM and the World Bank. And that swap was done because both parties had offsetting risk positions. And the swap was done to create a hedge for both parties, because one had an exposure to rising rates, the other had exposure to falling rates. It was like a marriage made in heaven. So you've got two natural parties when you're talking about swaps. You've got natural receive fixed parties, which would include corporate debt issuers, insurance companies, hedge funds, and those kind of things. In fact, there's been a tremendous amount of corporate debt issued just in the last month or so. A lot of that corporate debt is swapped back to floating because that fits these corporations' balance sheet needs more so than the fixed rate debt that they issue. So they issue fixed rate subordinating debt, and then they swap it back to floating. On the other side, you've got natural pay fixed counterparties. And right now, community banks, mortgage-backed portfolio managers, REITs, asset managers, those kind of things want to manage their exposure to rising rates by paying fixed on these swaps. So you've got this natural offset between pay fixed and the composition of the swap market. The bottom line, though, is supply and demand between these two natural parties is what creates the rates market that we have. And so when you've got a lot of corporate debt issuers coming to market, the natural tendency is for them to receive fixed. And so we tend to see rates fall when there are a lot of debt issuers coming to market, and vice versa. When those debt issuers leave the market, we tend to see rates move up. But bottom line is nobody's really out there speculating. I shouldn't say nobody. There are speculators in the market, but by and large, the market is made up of real investors who have a equal but offsetting position that needs to be hedged. So when you enter into a swap, don't think there's somebody on the other side that's betting against you. It's somebody on the other side who has a different risk exposure that they're hedging. So that brings up the question, what is an interest rate swap? And, you know, this is a really simple product, and most people get concerned that it's very complicated. It's not. It's a very, very simple product in which you have one party who is paying a fixed rate and another party who is receiving a fixed rate. And in exchange for paying or receiving that fixed rate, then you're going to pay or receive a floating rate. So there's two legs to every interest rate swap, a fixed rate leg and a floating rate leg. And we're not going to get into what's going on with LIBOR right now, but LIBOR is probably the most predominant, not probably, it is the most predominant floating index for the floating interest rate leg of a swap. And that's going to change in the future, but right now we're not going to talk a lot about that. There are some really important terms that you need to know that are associated with swaps and caps and floors and those kind of things. And the very first one is notional. Notional is somewhat synonymous with principal on a loan or a deposit, but it never changes hands. A notional amount is simply the amount on which we're going to calculate these fixed and floating interest rate payments. So if we do a $10 million swap, that means we're doing a $10 million notional amount of swap in which the interest payments are calculated based on that amount. So it never changes hands, but it is an important component of an interest rate swap. The floating index, obviously that's important because we want to know what the underlying index is. As I said, LIBOR is the most predominant right now. We're seeing many of our customers move away from LIBOR towards prime or even Fed funds. SOFR is the index that's been selected to replace LIBOR in the U.S., but we haven't seen a lot of SOFR swap activity at this point. So if you're new to this market, if you're not using swaps now, then you probably want to avoid using LIBOR and move to something like a Fed funds rate or a prime rate, depending on which one you prefer. Reset frequency describes how often that floating rate resets, and that can be from daily to monthly to quarterly to semi-annually, all the way out to annually. So you can have different reset frequencies on the floating leg of the swap. And the payment frequencies apply to both the floating and the fixed leg of the swap, and they can vary from monthly to quarterly to semi-annually. So those can be customized, and they're typically customized to meet the needs of whatever it is that you're hedging. And we'll talk a little bit about that in a second. And then term, that's kind of an obvious term. Term is a term, but it's obvious that it's the maturity. So swaps have a specific maturity date. So the term represents that maturity date. Some additional terms and definitions. The International Swap and Derivative Association, or ISDA. ISDA is the outfit that oversees the derivative market internationally. They came together in 1988 to kind of to create some standardization in the ISDA, in the derivative world, so that the contracts that were used in derivatives were more standardized and clearer and better understand. And so that brings up the ISDA Master Agreement. That's the agreement that all swap counterparties execute between each other. And that document spells out both parties' rights and obligations under all covered derivative transactions. So whenever you do a derivative transaction, you will already have an ISDA master agreement in place, and the transaction that you do will be evidenced by a confirmation of that trade. And that confirmation is simply an addendum, if you will, to the ISDA master agreement. In the post-Dodd-Frank world, Dodd-Frank did an awful lot to change the way the swap market worked, and they created a couple of legal terms that we need to talk about. One is swap dealer. Swap dealer, even though Vining Sparks acts as a participant in the swap market, we are not a swap dealer because we don't meet the definition, and it's really based on the size and the kind of depth of business that you do. We perform our function as if we are a swap dealer, but we are not a swap dealer from the legal sense of the term. But what that legal change did was it created some minimum standards for business conduct, record keeping and reporting and documentation. And it was a good thing. It was a very good thing, although it was painful to go through the change. The CFTC, or the Commodities Futures Trading Commission, is now the group that oversees the swap market. And so the interest rate swap market, I should say. The securities-based swap market is overseen by the SEC. A swap execution facility, or a SEF, that is a new term that came about with Dodd-Frank as well. And a SEF is an entity that is either a swap clearing or a swap exchange organization. And Dodd-Frank introduced the notion of cleared swaps. And we're not going to get into a whole lot of detail on that because most of you out there are not going to fall under the requirement to have to clear swaps. So, but know that a lot of the swap market is now not what we would call bilateral. In other words, between two counterparties. It is now in a cleared situation, or where those swaps trade on an exchange. The derivative value of 1 basis point. This is kind of a random term to add in here, but it's really kind of important in the way that we look at anything that we do related to swaps. And we shorthand for that is DV01. But all it is the present value of 1 basis point based on the notional size of the trade and the term. And you can use that term for profitability and risk management purposes. So it's a pretty simple number, but it has a lot of uses. So I'm not going to spend a lot of time on caps and floors because they're not that much different than what a swap is. The only difference is with a cap or a floor, you pay an upfront premium to buy that option. So if you buy a cap, basically you pay a premium. Now you own a cap, and that cap, that's the worst exposure that you'll ever have. What you pay for it, the value of it will never go below zero. So the market value of a cap is going to be what you pay for it initially, but that value will never drop below zero. It can go to zero, but it will never drop below zero. And so the differences between a cap and a swap are pretty minor. You have kind of the same terms to deal with: notional, floating index, reset frequency, payment frequency, and term, but you also have an additional thing to deal with, and that is the strike rate. And the strike rate is the rate at which you will begin to receive on that cap. So if you struck a rate at the money, which means you've struck a rate that's kind of at the money with a par swap rate, then you've got no room for rates to move up before you get paid. So if you strike the rate out of the money, which means you've created a strike rate that's above at the money, then it's much like insurance at that point. You've kind of created a deductible. You're going to accept the risk that occurs above the at the money rate until it gets to the strike rate, and then you'll begin receiving on the cap the difference between the strike rate and the actual setting of the index. Now, caps are obviously used to hedge against rising rates. Floors, on the other hand, are used to hedge against falling rates. And they're exactly like caps, except we're going to move in the opposite direction. The strike rate that you use is going to be lower. The strike rate is going to be lower than the index setting. So as rates fall, you're going to begin receiving on your floor when rates fall below the index. And again, you can set that strike rate lower to cheapen up the cap or the floor, as if just like you're expanding the deductible on an insurance policy. The bigger deductible you have, the lower the premium, but the more rates have to move before you begin receiving on it. But again, caps are used to hedge against rising rates. Floors are used to hedge against falling rates. Primary uses for swaps, pretty straightforward. A pay fixed swap is used to hedge against rising rates. A receive fixed swap is used to hedge against falling rates. And I know we had a lot of customers over the last year and a half who were concerned about falling rates, but never actually got their hedges off, and rates fell very, very hard, and it made it almost uneconomic to even think about doing a receive fixed swap because all of the risks that they had been trying to hedge had already occurred. So we don't see a lot of people doing receive fixed swaps right now, simply because rates have gotten so low. The only people that we have looking at that are some of the larger banks who believe rates are going to stay even lower or go even lower and stay even lower and possibly even go negative in the future. So we saw some hedging around that early in the year and late in 2019, but very little of that's going on right now. Most of the activity that we see right now is fixed rate payers where banks are paying fixed, and they're doing that for any number of reasons. And some of it is not just to hedge against rising rate exposure. Some of it is to create cheaper cost of funds or to provide the kind of products that their borrowers want. So those are your primary uses for swaps. Primary uses for caps and floors is just the same. If you want to buy a cap, you're hedging against rising rate exposure. If you want to buy a floor, you're hedging against falling rate exposure. One of the things that we always do when we talk to boards, et cetera, management teams, is we talk about how you would actually go about implementing an interest rate swaps program. And obviously the very first step is you got to have a business need. You don't just do this because you want to do it. You do it because there's a business need. That business need can be anything from we need to more efficiently hedge our interest rate risk exposure, or we want to take advantage of the swap market to create some really low cost funding, or we've got borrowers who want really long-term fixed rate loans. Whatever that case may be, you need to establish those business needs up front. You need to get buy-in from the board and executive management. And I think the best way to get that buy-in is to have legitimate business needs to show them. You want to implement the appropriate policies and resolutions. You want to have a derivative policy. Obviously, if you're going to do commercial loan hedging, you want to have a loan hedging credit policy. Obviously, you've got to have a resolution from the board that exempts you from mandatory clearing. Maybe that's not obvious, but any bank that's less than $10 billion in assets can exempt themselves from mandatory clearing, and we highly recommend that you do that. And the reason for that is simple: is most banks under $10 billion don't do that many transactions in a year, and the cost of clearing is about you've got a fixed cost of about $200,000 and then a per trade cost. So most of our customers, any bank, below 10 billion is not going to do enough trades to make it economic to clear. You want to have counterparty approvals. That means you've got to have somebody that you can do a swap with that you've approved. So you've got to have a counterparty approval process. You want to develop product parameters. If you're doing loan hedging, commercial loan hedging, you want to have product parameters around that: borrower rating, size of the loan, maximum and minimum terms, etc. Most of our customers elect to outsource their derivative support function. And the reason for that is because we provide all of that support for them. For finance, accounting, treasury, and operations, we provide all the accounting and back office support that you need to handle these. But those are things you have to have in place if you don't outsource them. The appropriate constituencies need to be trained, and that includes lending, operations, accounting, and finance. We do that if necessary. You got to have the appropriate approvals for people who can calls to somebody in finance or treasury. You want to establish your counterparty relationship.
Rick?
Yes.
We lost your audio for maybe 15 or 20 seconds. I don't know if it was material, but if you could just go back a bullet.
Sure.
Great, thanks. Sorry.
on the develop the product parameters, I'll start there. Does that work?
Sure.
If you develop product parameters, that's appropriate when you're doing commercial loan hedging. You want to have if you're going to do commercial loan hedging, you want to know the kinds of borrowers, the loan size, the maximum and minimum terms, in terms of maturities that you want to do, and actually sometimes you want to have lenders who are qualified to offer commercial loan hedging so that they don't mess things up. If you're gonna do swaps, you're gonna have some functions that are required within the organization that will involve finance, accounting, treasury, and operations. We do an awful lot of that. So if most of our customers outsource a lot of that to us to handle for them and provide that information to them that they need to properly account for these transactions, we provide all of that. If you want to do it yourself, you've got to develop all of that internally. You need to have the appropriate constituencies trained, and that would include lenders and operations and finance. You want to have the appropriate authorities approved for, executing these transactions and approving the credit, etc. So you don't want every lender in your organization executing swaps on your behalf. You want that centralized, in probably the finance or treasury area. Then you've got to go in and establish counterparty relationships, which means, we've got to establish a counterparty that we do business with. And then you've got to establish a collateral management process to meet swap margin requirements, because there is margin required on swaps. And in many cases, there are two forms of margin. I won't get into too many details on that, but there's an initial margin, or what's called independent amount. And then there's variation margin that's based on the market value changes of the derivative. So those are the things that you need to think about as you implement a swap program. In terms of the onboarding process, as you've approved that and you're ready to go and get going, then here's what the documentation that you would typically see. You're going to have an ISDA master agreement, which is going to have a schedule and then a credit support annex. The credit support annex is probably the most important part of the master agreement. The master agreement is boilerplate. There's very little negotiation there. The schedule is boilerplate, very little negotiation there. Credit support annex, that's where there can be some negotiation, but the market has gotten so standardized that there's very little change to any of those documents, very little negotiating room on those. You want to have a board resolution that approves or authorizes the use of derivatives. You want to complete your Dodd-Frank Know Your Customer information. And then, I mentioned mandatory clearing. We would send you a mandatory clearing exemption form that basically exempts you from mandatory clearing. So when we do a transaction with you, we submit that to our swap data repository that says this bank, even though they've got a swap, this bank is exempted from mandatory clearing, and here's the reasons why, and that's done on a form that we send. So those are your kind of documentation pieces that you would expect when you first set up a derivative program. Derivative accounting, this is what scares everybody the most, and I'm not going to spend a lot of time on it because it's gotten very, very easy. In August of 2017, FASB issued ASU 2017-12. Used to be referred to as ASC 133, which is now ASC 815. It made things so much current earnings, excuse me, and if you have done the correct hedge, then those should be equal but offsetting and have no impact on your earnings. And another thing that's been very positive with that change that the accountants made is that now we can hedge mortgages and consumer loans and things that have an option to prepay that don't necessarily behave according to an amortization schedule. So we can hedge mortgage-backed securities, we can hedge individual mortgage loans, and I say individual, we really would hedge those as a group of loans. Accounting standard, last of layer and partial term. So you can customize these hedges much more than you ever could before. And so I'm not going to get into any more of the accounting, but to say that we help with all of that. That's part of the value proposition that Binding Sparks brings to the table. We help you with all of this stuff. Now, this is the fun part. So in the last, let's call it 4 or 5 months, these have been the best transactions that we've seen, or ways to use derivatives that really seriously help you prosper. And the very first one, and this is just a concept more than it is a transaction, but provide products that are demanded by your customers. I'm sure a lot of you have borrowers, particularly on the commercial real estate side of things, who want fixed rates that are, 10, 12, 15, and even 20 years. And with rates so low, the bank tends to be a little reluctant to do that unless they have a commercial loan hedging program in place. In fact, I talked to a customer this week that it was kind of shocking. They don't do commercial loans greater than 5 years. They stop at 5 years, but they've got customers who want the product. And this is one of the ways that we get a good bit of business, is because we can help solve that dilemma with an interest rate swap. And I'm going to talk about that in bullet number 4, exactly how we do that. But funding has been probably the most attractive place to use derivatives in the last 3 or 4 months, and whether it be hedging a deposit, a home loan bank advance, a brokered CD, or any other source of wholesale funding. It's been really attractive. Asset portfolio hedging, where you might have an investment or a loan of some kind or a portfolio of some kind that you want to take the interest rate risk out of. You might be buying bonds right now at a really low rate and are concerned about rates going up. You can actually hedge those bonds and convert them to floating and offset the price volatility associated with that. And we've done a lot of that recently. Commercial loan hedging, and that relates back to item number 1 here. This is kind of bread and butter for us. This is the, kind of a steady business that works really, really well for the bank and the borrower. It's a win-win for both. In fact, there are typically fees paid on these swaps. We pay our bank customers when they do transactions with us, and last year, that added an average of 174 basis points to the profitability of new business. So the fees, if you're getting LIBOR plus 200 in the spread on a deal like that, and then we also give you another 174 basis points, so your first year profitability looks more like LIBOR plus 130, plus 374 rather than LIBOR plus 200. So it's a way to front load some of that income when you're doing commercial loan hedging. So let's talk a little bit about the funding opportunities that we see right now. When we look at wholesale funding, and again, I put on my balance sheet strategy hat here, I always say, let's pick the one that works best for your balance sheet. And so we start with brokered CDs. And the reason for that is it provides about the only unsecured source of liquidity a bank can find right now, particularly a community bank. So you can go out and you can borrow money in the brokered CD market, and it's cost effective and it does not disrupt local market pricing. But I think the most important part of this is it really creates liquidity, because you're not having to encumber any of your assets as collateral for those funds. Home loan bank advances obviously are the most readily available, and you can get it by calling the home loan bank and have it in your bank today. So that's the primary source of liquidity for most banks, but it really doesn't create liquidity in the traditional sense, because if I borrow from the home loan bank, then I've encumbered some asset that's being used as collateral for that. And so we have to think about that when we're funding our balance sheet. And then there's also these wholesale money market accounts, Stonecastle and Promontory, that offer the reciprocal deposits and the one-way buys or sells, those kind of things. Those are uncollateralized. Those are also good sources of liquidity if you need them. But anyway, you pick the one that makes the most sense for your balance sheet. If you've got plenty of liquidity, maybe home loan bank is your best source. But if you don't, if you're tight on collateral, then brokered CDs are going to be attractive. That's one consideration that you should think about. The other is, what does it cost? What does it cost to borrow? And you know what's funny is I put these rates together. It's always dangerous to put rates in a presentation like this too early. And I put these in here from the 3rd of June. And last Friday, I don't know if everybody's aware of this, but rates went up a lot last week, and particularly on Friday. Kind of a good news, bad news scenario, they're back down. So these rates are pretty accurate right now. And you can see that we've got three sources of funding. We've got LIBOR swap rates. We've got Federal Home Loan Bank of Dallas, because I had those rates. I didn't have all the other home loan bank rates. And then brokered CD rates. And you can see how they play out over the term of individual instruments. So one of the things that's really attractive is if you go out here to the 5-year point and you look at Home Loan Bank of Dallas. At that point when we did this, they were 92 basis points. Brokered CDs were 68 basis points, and swapped funding was 50 basis points. So my question would be, why in the world would you use Dallas Home Loan Bank or brokered CDs to create 5-year funding when it's only 50 basis points to do it with a swap? And that's been the really, people are scratching their head, know why I would do that. Let's do a swap. So how does that work? Let's see if I can get this next slide to come up. Okay, so how does that work? Well, it's pretty simple. I actually still have to borrow the money because the swap doesn't create any liquidity. Remember, it's just the notional amount that we're calculating interest payments on. I use brokered CDs here as my funding source. I use 3-month brokered CDs. So the bank would borrow 3-month brokered CDs, and then every 3 months they would roll those CDs. If home loan bank advances had been cheaper, I might have used home loan bank advances, but brokered CDs were my funding source for this exercise. Then the bank would execute a 5-year pay fixed swap. And so the details are below. So bank pays 3-month pays 3-month brokered CD rate. At the time we did this, it was about 21 basis points, and Jamin can correct me if I'm wrong on where that rate is now. The bank pays fixed on the swap. It was 50 basis points when we did this. It's actually a little cheaper right now. It's about 45 basis points. The bank would receive on the swap 3-month LIBOR, which is 31.7. Right now it's about 31.3 basis points. Their net funding cost for the first 3 months is 39.3 basis points. Now remember, if I went to the home loan bank to borrow that money, I would have been 90 plus basis points. Why would I spend an extra 50 plus basis points to get to the same spot? And that's what a lot of people have asked themselves recently is, why would I do that? And they've decided they're not going to do that. They're going to do it this way. And they're saving a lot of money. So, the risk here obviously is if you look at what you're paying on the brokered CDs, it's 21 basis points, and what you're receiving on the swap is 31 basis points. So you're going to roll that brokered CD every 3 months, and it's going to act kind of like a floating rate. But to the extent that those two offset like they are, you're going to get a funding cost that's really the fixed rate on the swap plus or minus the difference between the brokered CD rate and whatever LIBOR setting is at that point. Now, what's interesting, and this is an aside, is that LIBOR was dislocated from the market by a very wide margin back in March and early April. And in fact, LIBOR was 145 basis points. So if you go back to that, I won't go back to that slide. Yes, I will. I'll go back to that slide. If you can imagine that the LIBOR in number 3 here was 145 basis points instead of 31, I actually had funding costs that was negative for the first 3 months, and a lot of customers went in and acted on that strategy. So here's how it lays out with the boxes and arrows. In this case, the bank is going to issue some kind of wholesale funding. In this case, it's brokered CDs, and they're going to pay what's effectively a floating rate because they're going to replace that 3-month CD every 3 months. And then they're going to enter into an interest rate swap in which they pay a fixed rate and receive a floating rate. So their cash flows look just like this. They're going to pay floating on the deposits, they're going to pay fixed on the swap, and they're going to receive floating. So the two floating rates offset, and they're left paying the fixed rate, plus or minus that difference between the two floating rates. But it's a pretty easy transaction to do. Another trade that we did, and this is an actual trade rather than an example, this was a trade we actually did back in May. And this is an example of a forward starting swap. And the reason I wanted to use this is because it was so compelling of a transaction. The bank executed what's called a 2-year forward starting swap. That means the swap does not begin to pay or receive for 2 years. Now the swap is on your books, so the market value will be on your books, but there's no interim cash flow, so that has no impact on your income statement. They locked in really low fixed rates on future funding. In other words, they decided that they either were going to issue new funding or that they had some maturities coming up in 2 years that they wanted to go ahead and lock in today's rates on, and that's exactly what they did. And this happened to be a decent sized trade. It was $18 million executed on May 14th with a 2-year forward. So the swap begins on May 14th, 2022. The swap maturities that they actually did vary from 5 to 10 years. So they did some pretty long stuff. But what's interesting is their fixed rate is only 72 basis points. That's really attractive. Now keep in mind, this probably has a weighted average life of about 7 years. So they raised 7-year money at 71 basis points. And that is a home run transaction. In fact, there's a Wall Street Journal article talking about big corporations doing this very same thing because they felt like the opportunity was just too great to pass up, even though it's possible that rates could go lower and actually go negative. But they said that their thought process was the benefit of locking in a low rate now more than offset the potential cost of being wrong about the direction of rates. Now, a little bit about portfolio hedging. There's a couple of ways you can take advantage of the swap market here. The most important way to do it is, with not the most important, but one way to do it is using swaps to hedge individual or pools of bonds like mortgage-backed securities, municipal bonds, etc. So you can use an awful lot of that. And here's an example of one that we've done. The bank purchased a bank qualified muni. It was a 10-year no call 15 maturity. It had a yield at the time we did this of about 204 with price fall, and this is I think this was the raw yield and not the taxable equivalent yield, but 204 yield to call and price volatility of 23.6 up 300 basis points. That's not all that attractive to a lot of customers. They're going a 204 yield. It's going to it has risk of 23.6%. That's a lot of risk for a low yield. So what they do is they use an interest rate swap that converts that bond to in this case, it converted at 3-month LIBOR plus 121 basis points. And the swap actually offsets almost all, in many cases, all of the price vol. So your price vol is near zero. You've got a bond that's yielding you 3-month LIBOR plus 121 basis points. Typically, we only hedge these to the call date, but we could hedge it all the way to the maturity date using a cancelable swap. And the only thing that we're hedging here is interest rate risk. So muni spreads widen, those things aren't hedged. So you're only hedging the interest rate risk, but that's a pretty small component of the risk when you're talking about a long bond like that. Your interest rate risk is primarily the major risk in a transaction like that. Let's see if I can get this slide to move. Here we go. And here's what that looks like. So the bank buys the bond. They execute a 10-year swap because that 10-year call. So they're receiving 204 in the bond. They're paying 83 on the swap. That's 121 basis points difference. They receive 3-month LIBOR. So their all-in net floating yield for the first 3 months is 152 basis points. So they're giving up some yield, but they're also wiping out all of their price volatility. So again, the boxes and arrows on that, the bank receives a fixed rate on the bonds, the bank pays a fixed rate on the swap and receives floating, and here's your cash flows. So they end up with LIBOR plus 121 basis, 3-month LIBOR plus 1 going forward. Very good trade-off. Now, another way to do that is with a leverage transaction. So instead of swapping the bond, you go out and say you bought the bond with cash, you don't need to hedge your funding in that case. But in this case, if you were going to fund that purchase, we're going to hedge the funding instead of the bond itself. Same math. So I'm going to buy the same bond, and I'm going to use the same interest rate swap, and I'm going to create this spread of 121 basis points. Or I could have gone out and borrowed money using brokered CDs and borrowed 10-year brokered CD money, which was 116. I'd only have 88 basis points of spread. Or I could go to the Federal Home Loan Bank and borrow that money, and that 10-year rate was 140. I'd only have 64 basis points of spread. So you tell me, which is better, 64 basis points of spread or 121? And because we have so many banks that are looking for yield, they're scratching and clawing for yield in a bond, and they can get as much as 57 basis points just by funding it slightly differently, not mismatching it, but just using a different funding mechanism. Pick up 57 basis points. That's real money just by doing something a little bit different. And so that's the reason I ask, why would you not do that? It just makes so much sense. And a lot of our customers have obviously moved in that direction because they look at that and they go, yeah, I'm trying to find an extra 10 basis points in a bond that's not got a lot of risk. This doesn't change your risk at all. It's just a different way of funding it. So that's one way to do it. The other thing you can do is on the commercial loan hedging side of thing, and this has been around for a long time. It won't be new to a lot of people, but it's very straightforward. A lot of customers limit their, I don't know how many do now, but limit the terms to about 5 years. A lot of folks also will just go ahead and make a 10-year fixed rate loan and keep it on their balance sheet. That's probably not the way to create consistent quality earnings. So you need to think about commercial loan hedging, which converts those fixed rate loans to floating. And here's an example of this is, it's 10-year fixed rate with a 25-year AM. The competition's offering a 3.5% rate. Will you match it? And the answer is, yeah, of course I'll match it because I've got a swap program. So using loan hedging, you can convert that fixed rate to an effective Fed funds rate of plus 271 or LIBOR plus 258, whichever index you wanted to use. Plus, you can create those upfront fee income that I talked about before, which is typically about worth 170 basis points for the first year. And that's paid by the swap counterparty and not by your borrower. And we've got a product called the Smart Loan, and I'm not going to spend a whole lot of time on that, but the Smart Loan is a very, very simple product. It doesn't involve your borrower having a swap, so there's no ISDA master agreement required. There's no Dodd-Frank eligibility requirements. It's a very easy process to document and to use. You still have a swap on your books, but you are going to have essentially a fixed rate loan with your borrower that's being offset by the swap that you have. The borrower just makes one payment, so it's as if he's got a fixed rate. And the only difference between that and a traditional fixed rate loan is that there's a market unwind, meaning if rates move up, there's a gain. If rates move down, there's a loss that the borrower has to pay if they want to get out early. And as I said, fee income can be very material on these kinds of transactions. And I won't bore you with the boxes and arrows because they're just like what we've looked at before. In this case, the borrower pays the bank a fixed rate. The bank pays the swap counterparty a fixed rate and receives a floating. And it works just like all the other ones where you've got two offsetting fixed rates. In this case, the fixed rate from the borrower and the fixed rate on the swap, and the bank is left with a floating rate. In this case, 1 month LIBOR plus 258 basis points. So bottom line is commercial loan hedging is just extremely attractive in just about every market. Fees are paid by the swap counterparty, not the borrower. Immediate recognition, and this is not an optional treatment. Immediate recognition in the income statement for those fees, and those fees can be very helpful, particularly in an environment like we're in right now, to help offset margin compression. And down at the bottom it says be proactive. A lot of your customers are coming up for maturity right now, and one of the best ways to keep them from shopping a rate is to go to them and say, hey, let's go ahead and think about locking your rate in now while rates are really attractive, and let's do that. And so a lot of our customers will mine their portfolios for maturities coming up, and they'll also be proactive with new borrowers and saying, hey, do you want to lock the rate in now? We can go ahead and get a forward rate lock agreement in place using this forward start. And so the bottom line there is just help them do that. Help your borrowers with this process. So that takes me to the recap, and I've used about 5 more minutes of my time than I meant to, but the bottom line with all of this is interest rate products are the most effective tools for managing interest rate risk, but they're also products that can help you improve your margin when compared to alternatives. They create a win-win situation when it comes to customers in the bank, because customers and banks' interests are often in conflict. Bank wants floating rate, borrower wants a fixed rate, or on the deposit side, the borrower wants a floating rate and the bank wants a fixed rate, or vice versa. Depending on what the market situation is, banks and their customers' needs are often in conflict, and this is a great way to help match those two different needs up. They're readily available to community banks and mid-sized banks, and we're part of the reason that they are readily available, because we're a counterparty for those customers. But education and training are the keys to proper use, and we help provide that. But more than that, we provide specialized expertise that's beneficial for strategy development, trade design, and trade execution. And I can't overemphasize that, because you can have a 10,000-foot view knowledge of the swap market, but when it comes right down to creating a hedge that works exactly like we think it will, you got to have some experience with that, and that's where we come in, and that's where we can help. And so with that, I'm going to turn it over to Jeff in the panel for questions.
Great job, Rick. Thank you so much. We do have a few questions, so what I'm going to do is take us to the hour. And in the interest of time, Rick, I'll probably direct these towards you, and the panelists can certainly chime in, but let's see how far we can get through. And if we have some left over, we'll certainly respond to those of you that have submitted these questions directly. By the way, quick response that several of you have asked is, are the presentation available? It is available both in presentation and recorded form. Just shoot us a note or give us a call, either vis-a-vis go to webinar or our direct email. So here, Rick, here's the first question. You talked briefly about the accounting, but I've always heard it's difficult, and it is difficult, and any mistakes or changes in relationship can lead to financial restatements or other issues. Can you address the difficulty of accounting and what is involved for someone who has never done derivatives?
Yeah, that's actually a really good question. The restatements that occurred, most of those occurred back in 2006, and if we think about FAS 133, it came out in 1998. And in 2006, it was still relatively new. And what a lot of people had done was use what's called the shortcut method. And the accountants started cracking down in 2005 and 2006 on the shortcut method of hedge accounting. And they found that many institutions didn't qualify for shortcut accounting, and that created what's called an accounting error. And for those of you familiar with accounting, an accounting error requires restatement of past financial statements. And so that was kind of a bad thing for a lot of institutions. The latest accounting standards that have come out, though, have made hedge accounting much more flexible. And for example, if you elected to use shortcut accounting now and you were later shown to not qualify for shortcut accounting, you're able to switch to hedge accounting or long haul hedge accounting, as it's sometimes known, without creating an accounting error. So the accounting has become much more reflective of actual practice and the way people use these, and it's much more aligned, or the new accounting standard has aligned the accounting and the economics of these transactions much better and created a lot of flexibility that we didn't have before. It's a very specialized area of accounting, and that's one of the things that we tell our customers is, because we're not accountants, although I've got a lot of CPAs on my staff, but we spend an awful lot of time understanding the accounting associated with it, so we can help you with that accounting and make sure you're properly handling the hedge accounting and the FASB requirements to do that. But again, it can be a little daunting, but it's not that difficult once you kind of understand what's going on.
Great. I'm going to try to squeeze one or two more in here, Rick. What size bank do I need to be for swaps to make sense? I know the big banks have used them for years, and I've heard stories of them not being good for their customers.
Yeah. It really depends on whether the level of knowledge you're willing to gain, or the amount of sophistication you have, I guess is another way to say it. I will tell you that we have done business with banks as small as 30 million in assets, and the reason that we did is because they had a legitimate need and management understood what they wanted to do. Our typical customer ranges from 250 million in assets to well over 5 billion in assets, and so it doesn't matter about the size. It really matters about the needs that they have. And so I would suggest that anybody that thinks they have a legitimate business need consider these products, because most of the kinks have been worked out over the last 20 years, particularly with the accounting. And so it's a very well understood product, particularly from the regulatory standpoint. I won't tell you that they won't have questions, but they understand if you've got a need and you've documented that need properly, they're not going to have a problem with virtually any bank using derivatives.
Great. I have a couple of other ones, but I think they're relatively complex. And so for those of you that submitted these questions, I'll ask Rick to direct a response directly to you so that we get the full value of the response and not try to bifurcate it. So with that said, there is one kind of loaded one that one individual did ask if CB Resource does support this in their strategic planning or policy group. And my short answer is we do, to the extent it has a strategic bearing. We don't get directly involved in this type of work. That's what we rely on our strategic partners and subject matter expertise like Finance 500 and Vining Sparks to do. But thank you for asking. So with that, again, Rick, great job. Thank you so much for carving out the time to support today's session. I would like to say on behalf of Vining Sparks, Finance 500, and CB Resource, we'd like to thank you all for taking time out of your busy schedule to participate in the session. We hope you found it useful. We do know that there's a lot of pressure on earnings these days, and we do like to believe one of our primary purposes is to assist our clients in focusing on how we can support building sustainable, optimal earnings. And so with that said, should you need any other information or questions, if you request a presentation, our contact information is on it. But with that said, Rick, great job. Thank you, panelists. For those of you that asked the questions, we'll get those back out to you. And keep an eye on this upcoming series where we will continue to explore valuable ways to enhance and improve earnings in these challenging times. Thank you.
Thank you, everybody.